Today, we are going to compare two very popular ETFs on YouTube. On the left, the Contender 1, we have the Vanguard Total Stock Market ETF. And on the right, Contender 2, much smaller, weaker, flabby. We have the SCHD ETF, the Schwab US Dividend Equity ETF. Now, I make fun of SCHD all the time, but it has performed well in the past. I'll give it that, okay? That's why it has the right to be compared against VTI. So we're going to compare these two ETFs, and then I'm going to give you my ultimate opinion. So you're going to see the expense ratios compared. We're going to look at the prospectus of each ETF, and then we're going to look at a back-tested portfolio, one of which went 100% into VTI, and one of which went 100% into SCHD, and we'll see which one did better. So the first thing I notice is that VTI has a 0.03% expense ratio, while SCHD has double the expense ratio. But they are both extremely, extremely small. I'm not going to sit here and say SCHD is bad because of the expense ratio, even though it is double the Vanguard expense ratio. If you own either one of these ETFs, you're getting access to a basket of securities for a very, very low cost, okay? Assets under management, both very large. Obviously, VTI is way more popular than SCHD, but you can't laugh at SCHD. It's got $46 billion under management. Now, here's the first thing that I personally don't like. The VTI ETF is a true index. It literally owns or seeks to track the performance of the entire U.S. stock market. And it does it at market cap weights. We'll read more about it later. SCHD is a little bit different. They only have 101 stocks, and they are very selective in the stocks that they put in the index. So while the index itself, which is the Dow Jones U.S. Dividend 100 Index, while it is an index, to get placed into the index, there are active decisions being made. There is an active selection process. With the Vanguard VTI ETF, they're just buying the whole market, basically. Okay, they're trying to approximate the market as much as possible. So you can see, at least hopefully you can see, that there is some active management involved in SCHD. And if you don't see that because you see the word index, then I don't know what to tell you, okay? So we scroll down, there's a little bit more about expense ratios. We have performance here, but we'll get into that later. And then we look at the top holdings, okay? Now, here is something that I want to really explain to you. If you owned SCHD over the last 10 years, you would have done very, very, very well. Okay, you would have knocked it out of the park. You would have had fantastic returns. You would have had a solid dividend, and you would own a bunch of great companies. I mean, you look on the right and you see them: AbbVie, Verizon, Cisco, Pepsi, Chevron, Coke. Those are all fantastic, profitable companies. But why would you want to exclude other amazing companies like Apple, Microsoft, Amazon, Tesla, Nvidia? And why would you want to exclude other companies that we don't even really know about yet that are eventually going to rise to dominate the Vanguard Total Market Index? Because there are so many stocks out there that we don't know about that are, really small companies that are going to be the giants of the future. By buying VTI, you're invested in those stocks. When it comes to SCHD, you're probably not invested in those stocks. The next thing I notice is the weightings. The weighting for VTI is at market cap weights. Larger companies have more representation. And the top 10 stocks only have 21%, or only 21% of your total portfolio. Look at the concentration for SCHD. So while they say, oh, you have 101 stocks, you're actually pretty super concentrated in the top 10, because 41.75% of the entire SCHD ETF is in the 10 top stocks. So that's pretty concentrated in my opinion. Now, how are the stocks in SCHD selected? Well, we can see it tracks the Dow Jones US Dividend 100 Index, and it measures the performance of high dividend yielding stocks. So it ignores stocks that don't pay high dividends or don't pay dividends at all, because dividends are not the end-all be-all, as you'll see in a second. That have a record of consistently paying dividends, selected for fundamental strength relative to their peers, and based on financial ratios. So here's more detail here. All index-eligible stocks must have sustained at least 10 consecutive years of dividend payments. So if they only paid dividends for 9 years, I guess they wouldn't make it in here, okay? Have a minimum float-adjusted market cap of $500 million, even though some fantastic companies have started at much smaller market caps than that. and meet minimum liquidity criteria, okay? Whatever that means. The index components are then selected by evaluating the highest dividend yielding stocks based on 4 fundamental base characteristics. So you see, it's active management. Okay, look at this. Cash flow to total debt, return on equity, dividend yield, 5-year dividend growth rates. Then they are weighted based on a modified market capitalization approach. So there's so much selection that goes into this index, okay? Regardless of how well it's performed, you have to acknowledge that there is a very strict selection process behind the stocks that go into this index. You compare that to VTI, what does it do? Okay, it's an indexing investment approach designed to track the performance of the CRSP, CRSP, whatever you want to call it, U.S. Total Market Index, which represents approximately 100% of the investable U.S. stock market and includes large, mid, small, and micro-cap stocks. You own everything, okay? You own it all at basically market cap weights instead of actively selecting stocks. Because I can tell you, active management tends to underperform over time. Over time, it tends to underperform. And with SCHD, you're not getting that much. Now, let's go ahead and do the portfolio visualizer. So here, I did a 10-year performance. And I want to be upfront about this. Past performance is irrelevant. If somebody comes up to you and says, this ETF went up more, therefore it's better. This ETF performed better, therefore it's better. If somebody says that to you, they don't know what they're talking about. Past performance is not indicative of future performance. Something can do great in the past, and it can absolutely blow in the future. There's so much more that goes into analyzing something than just looking at stuff that went up a lot. If that was the case, you'd probably put all your money in Dogecoin and Bitcoin. So anyway, in this scenario, we have a 10-year time horizon, and we have an initial investment of $10,000. So we're going to put $10,000 into SCHD, and we're going to put $10,000 into VTI starting in 2013, and we're going to see which one does better. So we go down, and the first thing we see is that, obviously this is the portfolios, is that SCHD has actually outperformed VTI. Now, SCHD investors will say, see, VTI has underperformed SCHD. Therefore, you must buy SCHD. And they're actually very, very highly correlated, okay? But that's in the past. Now, when you're buying an index, when you're investing, if you believe in buying indices and you're not a big fan of stock picking and you believe it's almost impossible to pick stocks and beat the index, why would you buy anything other than the index, the total market index? It makes absolutely no sense. You're trusting a selection process that worked for a very specific period of time to eventually arrive at some kind of future goal, which I think is dangerous. But over the last 10 years, SCHD has underperformed, and it looks like it's been less volatile than the market. So we go down, and there's more annual returns. And then we have income. Dividend income is cash leaving the business. A business has cash. It decides to give out that cash to the shareholders. That is a dividend. It is not excess return. It is not free money that falls from the sky. There's cash in the business. It leaves the business. That's it. Here's the thing. Cash is, that dividend is taxable. You pay tax on that dividend. So you can see the income of SCHD versus VTI is actually going up. The dividends, they're actually exploding how much dividends they're paying. Basically, it's more than double now. So you're getting double the dividend yield, right? Double the dividend distributions, but that means you're also paying double the taxes, okay? So to buy this just because you're getting income, you're just basically inviting taxation. You go look at your tax form. Go look at your 1040. Go look on the first page. You'll see dividends there. Trust me. And trust me, you're paying taxes on those dividends, okay? Even if they're qualified dividends, depending on your income. So overall, my overall thoughts is, okay, like why exclude all these amazing companies and all the companies of the future that we don't know about that are going to dominate the index? Why only buy certain companies that are actively selected? Okay, they're actively selected. Why own 101 companies when you can own 3,896 companies? Just a thought there, ladies and gentlemen, okay? But if you look at past performance, okay, SCHD has done better. Therefore, I guess in your minds, it's going to do better in the future. which doesn't make sense to me. But that's kind of my thoughts. That's the comparison. They're very different ETFs, and they each try to accomplish a different thing, but whatever. All right, guys, talk to you later.